Everyone, today we are going to discuss about a very relevant topic, that is deferred tax asset and deferred tax liabilities. What is actually this deferred tax asset or liability is, where it is presented in the financial statement, how it is derived, and what to interpret it from the deferred tax asset and liabilities while reading a financial statement or while analyzing various financial ratios or while reading the or while assessing the impact of that asset or liability. We will also go through one news article which, while presenting a result of a listed company, they emphasized on this deferred tax again. So we'll also go through that. So India's 12 covers this particular aspect of deferred tax asset or liability. The name is India's 12. Say it talks about the income taxes. So accounting profit is the profit for a period before deducting the tax expense. So let's go through some of the important definition one by one. Taxable profit says it is the profit for a period determined in accordance with the rules established by the taxation authority. So in case of India, you see the Income Tax Act 1961 is there. So in accordance with this Income Tax Act, the taxable profit is derived, whereas accounting profit is derived through various accounting principles. India's accounting standards are there. So based on that, the provision of Companies Acts are there. So based on that, accounting profit is derived. Taxable profit is derived through the provision of Income Tax Act 1961. Whereas tax expense or tax income is the aggregate amount included in the determination of profit or loss for the period in which the current tax or deferred tax relate. So the tax expense is derived based on the accounting profits, whereas current tax is the amount of income tax payable in respect of the taxable profits for a period. Means it says that the current tax is dependent on taxable profit, whereas deferred tax liabilities are the amount of income tax payable in future period in respect of taxable temporary differences, whereas deferred tax asset is the amount of income tax recoverable in future period in respect of deductible temporary differences or the carry forward unused losses or carry forward of unused tax credit. So this was more of a definition part I thought you should be aware of. Now let's come to one example which will clarify all the theory or definitions which we have read or seen just now. Suppose, as per accounts, your accounting profit is rupees 100. A company ABC is there. So the accounting profit is rupees 100, whereas as per the Income Tax Act, the taxable profit for the same company is say rupees 110. So say suppose the tax rate is 30%, so your tax expense will be rupee 30, whereas your current tax will be rupees 33. So in this case, what happens is your tax expense, that is rupees 30, is equal to rupees 33 minus rupees 3. This minus says there is a creation of deferred tax asset, because you have already paid a tax of rupees 33 as per the income tax provisions, but you needed to pay only 30. Because of some of the temporary differences, you paid rupee 33 now. So these 3 rupees you need not provide for in future. That's why you are going to create a deferred tax asset. Let's take it other way around. Suppose, as per your accounts, your accounting profit is say rupees 200, and as per the income tax provisions, your taxable profit is say this year it's only rupees 150. Say for example, the taxation authorities allowed you more expense, say given in this case, or say that some taxable income is less. So in these two, now we are going through this particular scenario. In the first example, this first example is pertaining to this scenario. Now we are taking the scenario number 2, wherein the tax expense is allowed higher by the tax authority or the income is low. So the income is low, so as at the rate of 30% your tax expense will be rupees 60, whereas as per the provision of IT Act your taxable profit will be rupees 45 only. So your tax expense will be 60 is equal to 45 plus the balancing figure will be 15. That is your deferred tax liabilities. So you see, this is how the deferred tax liability is generated. So the equation is your tax expense is equal to your current tax. If the figure is in plus, then it will be a deferred tax liability. If the figure is in minus, then it will be a deferred tax asset. So in this case, the deferred tax liability of rupees 3 was created. In this case, the liability of rupees 15 is created. Why? Because there has been a temporary differences in say some expense were allowed by Income Tax Act in one go, where as per the accounting rules, say for example, we have from the accounting point of view, or as per the provision of Companies Act, we have charged lower depreciation, but the income tax authorities, they allowed higher depreciation. So in future you will not be able to claim the higher depreciation, because the depreciation amount will be maximum to the extent of the carrying amount of the asset. So to that extent you have created a liability, because in future you are going to create expense for that. So that's how the deferred tax assets and liabilities are created in books of accounts. It's nothing but to create a harmony between the calculation of profit as per the provision of Companies Act, as per the relevant Ind AS, and reconcile it with the profit which is calculated as per the provisions of Income Tax Act. So as I told you that there are some temporary differences, because of that you need to create the deferred tax asset or liability as per the scenario. So temporary differences are the differences between the carrying amount of an asset or liability in the balance sheet and its tax base. So the temporary differences may be either the taxable temporary differences or the deductible temporary differences. So taxable temporary differences is like in future they are going to create the deferred tax liabilities, but deductible temporary differences are the deferred tax asset. Tax base of an asset or liability is the amount attributable to that asset for the tax purpose. So this is more of a theory. So what actually a tax base is, I'm going to explain it through an example. But before that, let me come to one very important basic difference between the this Ind AS 12 as compared to the erstwhile AS 22, which talked about uh, which gave more emphasis on the income approach. The P&L approach was there, whereas this Ind AS 12, it it is driven by the balance sheet approach. What does it say? That when the carrying amount is more than the tax base, then you need to recognize the deferred tax liability, that is a taxable temporary differences. On the other hand, when the carrying amount is less than tax base, you need to recognize deferred tax asset. So as I told you that unless and until we do an example, then it will be very much easier to understand those principal lines. So let's take an example. Suppose an asset is there costing rupees 1 lakh. You acquired, company ABC acquired it, say 1 lakh is the price. So the depreciation as per the Companies Act, or which the company ABC follows, say it charged a depreciation of rupees 20,000 for the first year. So the carrying amount of the asset at the end of the first year, the carrying amount, if you see, carrying amount means the amount at which the asset is carried at balance sheet. So the carrying amount will be rupees 80,000. Now Suppose in this case the depreciation allowed as per the Income Tax Act is only rupees 10,000 and not 20,000, then what will be the tax base? So it's simple. The depreciation which is allowed as per the income tax is only rupees 10,000, means 1 lakh minus 10,000 means rupees 90,000. So rupees 90,000 is your tax base. Now what did it say? When the tax base is more than the carrying amount, you need to recognize the deferred tax asset. So how the deferred tax asset is created? Let's understand that. Suppose the profit before depreciation is say 2 lakh. So this is the accounting profit, and say this is as per the IT Act, taxable profit. So 2 lakh is the profit before depreciation. Now suppose depreciation, we know that as per the company's policy or the Companies Act, it is 20,000. So your profit, accounting profit, will be rupees 1,80,000, whereas for the IT Act it will be minus 10,000, it will be like 1,90,000. So your tax expense will be, tax expense, say 30% is the tax rate, so 54,000 is your tax expense, whereas your current tax will be 57,000. That's 30% of 1,90,000. So we know that tax expense is equal to your current tax. If it is plus, then deferred tax liability. If it is minus, it is deferred tax asset. So in this case, the 54,000 is equal to 57,000. There is nothing plus, minus only, minus 3,000. Means you have a deferred tax asset already created in your books of account. So as I told you, in this scenario, create or recognize a deferred tax asset. So yes, we have already created a deferred tax asset. In the first year we created it. This is the second year, again we are going to create it. So in future this deferred tax asset will be utilized, because we have already paid a higher tax rate. We need not pay that in the future. So this is how we are going to derive economic profit from this deferred tax asset. You know the basic definition of asset, that you are going to derive some economic benefit out of that asset. So this will be recoverable. This will be adjusted against the future payables. That's why it's a deferred tax asset in this example. Take one more example. Let's come out of this depreciation example. Let's say interest receivable is there. You have a balance sheet. In your balance sheet, this is the liability side, this is the asset side, and you have some interest receivables or accrued, say rupees 100. Okay, so the related interest revenue will be taxed on cash basis. Of course, as per the Income Tax Act, the interest revenue or income is recognized on cash basis. So even though on accrued basis you have recognized it as an income, but as per the provisions of Income Tax Act, you need not recognize it as an taxable profit, because you have not received it yet. So the tax base of the interest receivable is nil. So your carrying amount is rupees 100, whereas your tax base is nil. It says that your carrying amount is more than the tax base. It means you need to create the deferred tax liability. How? Your accounting profit in this case is 100. Your taxable profit in this case is 0 only, because you have not received it yet. So tax expense will be 30. Current tax will be 0 plus 30. In case of plus, it will be deferred tax liability. If the minus, then it will be deferred tax asset. So since this is a plus, this will be a deferred tax liability. So in this case, a deferred tax liability will be created. Take the third example. The trade receivables have a carrying amount of 100. So trade receivable means debtors. So debtors, what is the entry? Debtors account debit to sales. So the sales have already been recognized in P&L. So this debtor is there. This is the tax base or accounting base. This is the carrying amount of your debtors. Carrying amount say 100. This sale has also been fully recognized in P&L, and there is no such stipulation in Income Tax Act that only the realized sale will be taxed. There is no such stipulation. Means your tax base of debtors is also 100. There is no difference between these two. Means there will be nothing, no direct tax asset, or there will be no direct tax liability recognized in your balance sheet, because they are matching. There is no difference, there is no temporary difference. So hope through the balance sheet approach I have been able to explain you the what is actually tax base is. Though for the calculation of it I have taken some examples only, but I hope through these examples this explanation will help you. So the current tax asset and current tax liabilities, sometimes they are also there. So this India's 12 also talks about the current tax asset or liability. They are nothing but the income tax paid in advance. Your current tax is there, you have already paid it in advance, then it is not a deferred tax asset, it is current tax asset, and you need to pay it. You have a liability but you have not paid it yet, then the current tax liability will be created. It will be shown in the balance sheet. Both of they are the balance sheet items only, just like deferred tax asset or deferred tax liabilities. So in the books of accounts, where these deferred tax assets and liabilities they are shown. So deferred tax asset is shown under the head non-current asset. If it is an NBFC or financial institution, then it will be shown in non-financial asset as per the Schedule 3 of Companies Act. This depiction will be there. This will be as per the Schedule 3 of Companies Act 2013. Whereas liability will be sold under non-current liabilities, or if it is NBFC or say NBFI or financial institution, then it will be shown under non-financial liabilities. What RBI has to do with this deferred tax issue? Because recently RBI has given so many press releases that what should be the adjustment of the deferred tax asset or liability by the NBFCs or banks or financial institution, because they need to create the CRAR. So CRAR calculation is there, capital adequacy ratio, So for capital adequacy ratio, tier 1 capital is there, tier 2 capital is there. So based on that the capital adequacy is determined. So RBI has clarified through a press release that tier 1 capital will mean paid up capital, statutory reserve, other disclosed reserve reduced by deducted from this. So what item will be deducted? It will be deducted by investment in subsidiaries, intangible assets, losses in current accounting period, deferred tax assets. So that's why it's very important. Means banks or FIs, they need to reduce the deferred tax asset which is already created in your balance sheet, which is available in the non-current asset side. You need to reduce it from the tier 1 capital. Likewise, it also says some double stars there in intangible, that full amount of intangible assets to be deducted net of any associated deferred tax liabilities. So if the deferred tax liability is related to some intangible asset, then that will be reduced from the intangible asset, and then that intangible asset will be reduced from the tier 1 capital for the purpose of RBI regulatory requirement. This is applicable for financial institutions or say NBFCs or say banks. These are not applicable for common companies. For common companies, you need to refer Companies Act provisions, which are like this. So I told you that one of the news article, I'll show you that why this deferred tax gain has made some news headline recently. It says that Suzlon Energy Q4 net profit zooms 365% to 1182 crore. on deferred tax gain of rupees 600 crores. So because of this deferred tax gain, they have gained this much of profit, which is 365% up. So for that I took this statement of financial result. So you see the profitability of Sujulon, it went up from 430 to 1174. If you analyze the whole this income and expense account, you will see that their deferred tax asset is 599.99, that is like 600 crore only. So because of that, you see the major jump is because of this deferred tax asset. So it's, since it is minus, so it's mainly deferred tax asset only. So why this deferred tax asset of 599.91 was recognized? On yearly basis, that you see it went up from 700 to 2100 crore. So going by the annual report or this result document only, it was mentioned that during the quarter ended March 25, the company recognized deferred tax asset of rupees 599.91 and 638 crore respectively, means on the for the quarter end or for the year end. On previously unrecognized, this is the most important point here, unrecognized unabsorbed depreciation and business loss based on the probability of sufficient taxable profit in future against which the unabsorbed depreciation will be utilized. So while reading it, one question came to my mind, that when you know that, say for you example, you already have some losses in business, so then your accounting profit, and then here comes your taxable profit. We know that when your tax expense, and here is your current tax, when your tax expense is less than your current tax, then comes the deferred tax asset. This is what we have read till now. So when there are heavy losses, you must have recognized the deferred tax asset at that time only, because the income tax allows the carry forward of losses, say 8 years, but there is no such stipulation in the accounting. You will account all the losses as per the provisions of Companies Act, as per the provisions of Ind AS or accounting standards. So when your tax expenses were already so low, say it's zero or say negative, and your current tax say rupee 100 is there, because you need to carry it forward till the time you have taxable profits, from them only you are going to adjust it. So you should have created deferred tax asset at that time itself when you incurred the losses. So this question came into my mind, but then again you go by the basic definition of asset. Since the deferred tax asset itself is an asset, so there is a recognition criteria. The recognition criteria says the unrecognized DTAs are reassessed at the time at the each reporting date and are recognized to the extent that it has become probable that future taxable profit will allow the DTA to be recovered. Suppose you recognize the deferred tax asset at the very year in which you incurred the losses, but you don't know whether in future or in coming 8 years you are going to you have that much profitability to adjust for those losses. So since that is not clearly probable at the year in which the losses were incurred, so that's why the deferred tax asset were not recognized in initial years, and it became more probable when the company started earning revenues from which the past losses they are going to be set off. So that's why company has written it that based on the probability of sufficient taxable profit in future again which such unabsorbed depreciation business losses will be utilized. So that's how when the coming years the business started earning profits, they recognize the DTA and not the year in which the losses incurred, because at that time there was no such probability of generating income. So I hope this deferred tax asset or liability explanation, and that how the deferred tax gain here means deferred tax asset only. So how this deferred tax asset of rupees 600 crores enhance the profitability of the company. So you see how they are the deferred tax asset or deferred tax liability has an impact on the profitability of the company. Deferred tax asset is going to increase it, deferred tax liability is going to decrease the profitability. How they are adjusted from the net worth, especially with reference to the RBI circular. Sometimes while calculating the tangible net worth, the tangible net worth is like your net worth minus intangible asset. So sometimes the deferred tax asset may also be reduced from, because deferred tax asset has been, by nature it is like an intangible asset only, though it is not an intangible asset, but it has no tangibility as such, but it is going to adjust your future tax expenses. That's why it is there. But in adjusted tangible net worth, the deferred tax assets, they are generally reduced beside the investments. So this is how the deferred tax asset, what the deferred tax asset and liability is, how they should be interpreted, what impact they has on your profitability or the balance sheet analysis, what is it has a role to play to increase the profitability. So this is a very relevant topic. I hope my explanation helped you to understand it. Thank you.